Hello, my name is Ralph Sayers. I am a CPA in Florida, and I help businesses and individuals with the IRS trust fund recovery problems in all 50 states and for U.S. citizens living abroad. This video explains the things that you must know about the trust fund recovery penalty, or TFRP as it is often called, and outlines ways to resolve trust fund problems. This video covers 14 topics, and I will go over the key points of each topic and then explain the key points in more detail. How does the IRS collect the trust fund recovery penalty? IRS actions are aggressive, and they include levy of your bank accounts. And let me explain what a levy on a bank account, how that operates. When the levy hits, your money is locked down for generally 20 days. That's how much time you have to do something about this. And in other words, have the levy lifted. And you can't wait to the last minute, because well, you can, but if you do, the closer you get to that 20th day, you think you have the full 20 days, but in my experience, not necessarily so, because the banks on that last day, they've already done administratively the things that they do to process that, because they are proactive about making sure that money goes out on time. And you can call your bank, and if you're down to the wire and haven't find out when their cutoff is for that, but they generally cut off at 2 o'clock, so your money could go out a day ahead, and I've seen that happen. It's gone before the taxpayer realizes it. So, but the only hit is only for that one time. It doesn't stay on your bank account. And normally, you don't get another hit for, I'm just saying most of the time, you don't get another hit for a long time. Now, and part of the reason you don't get another, in my experience, a taxpayer doesn't get a hit for a long time is because they've gotten into contact with the IRS. They've established some kind of relationship where they're actually working with the IRS, and that is what keeps the more levies from coming. Avoiding the government and not contacting, not doing the things that you need to do, that can cause your bank account to continue to be levied. Now, the levy against a payer works differently than the levy on a bank account and the way it operates. First, let me explain what I'm talking about when I say payer. It's anybody that's paying you or your business money. For example, if you or your company is getting money on commissions, then that's what we're talking about. It's a payer. And the IRS, if they're have been historically getting a 1099 from somebody that's paying you, they have that company or that individual's information in their database. So it's a fairly easy thing for them to do, to levy companies or individuals that have been sending you 1099s. The problem with levy on a payer isn't just that you're out the money. You could be out the customer, because the customer gets this legal information that explains to the people in their accounting department that it's a crime not to do these things. It does sound very threatening to them. It scares people who work there, because they are individually can be held liable. And so it can damage your relationship with the people who are paying you or your business. It can destroy those relationships. So the IRS normally it will hit a bank account first, then they'll go after payers second, and that is more, I would consider that more aggressive than hitting the bank account. They also can levy your property. The reason, or this is my explanation of the reason, that they don't hit your property so much with a levy is because they just don't have the resources to deal with it. They would have to liquidate the property, whereas a bank account or a levying a payer, that's cash, that's liquid, and they don't have to take care of that. With a property, they may have to take care of it, they may have to store it, they may, it could damage your business or somebody else's business, then they might have some situation legally with that. So they don't normally, and they don't have the legal people. So that's an end resort. It does happen, but that's not the first thing to happen. That's not so likely. But on property, they will attach a lien to protect their interest, so that if you go to sell your property, then let's say, for example, if it's real estate, they would be at the closing table waiting for their check for the equity that comes out of that property. And, in extreme cases, the IRS will restrict access. In other words, when after the close of the business, everybody leaves, the IRS comes in, it's a U.S. Marshal comes in, and he puts a yellow tape on the door that says, you know, do not cross this yellow tape, you know, it's a crime and all like that. And so that forces the business owner to do something, to contact or whatever they're trying to get you to do. And sometimes the IRS just does the things that it needs to do to close a business. Okay, now I just want to run through a simple example to show you how the trust fund recovery penalty works in practice. Let's assume that your corporation, we call it XYZ Corporation, owes $100,000. The IRS assesses the trust fund recovery penalty against the president of the corporation and against the majority stockholder. The corporation, the president, and the majority stockholder now each owe 100% of the unpaid payroll taxes. Let's say for example the uncollected taxes are $100,000, and the two responsible parties that the IRS assesses the trust fund. There are two parties that are being assessed. The two parties in this example are the president and the majority stockholder. And unfortunately, what happens in practice, the IRS frequently collects more than the penalty from responsible parties, and that is because the IRS has never set up a system to adequately coordinate and control the collection of the trust fund recovery penalty from several persons. And in this example I'm going to show you, you'll see how that can be complicated, and there's timing issues and a lot of other things involved. I mean, they're issuing levies and hidden bank accounts and that sort of thing. And plus at the same time people are sending money in to get the IRS off their backs, and the timing of when these monies hit the system, it can get overpaid. So if the IRS overcollects, then the respective parties have the right to request a refund. But the process is a long one, and it is quite involved. As a general rule, the last person who paid after the full collection of the tax, that person would be entitled to a refund from the government. So there is no balance, as far as the government is concerned, there is no balancing mechanism to even things out. They got their money and they're walking away from it. You do have the right, parties have the right to go against one another, but I'm going to stick with this example right now, and let's just say the company's trust fund recovery penalty is $100. I mean $100,000, and you, the president, are assessed $100,000. So you pay. Let's say they hit your bank account, or you mail them a check, or a combination of the above. You paid $90,000. So that only leaves a balance of $10,000 that's due. So now only the corporation only owes 10, the other party only owes 10, and you as well still owe $10,000. So everybody owes 100% of the balance that's due. So now let's say person number 2 that has sent in a check for $11,000, and it comes in, let's say, the day after you've paid them. So they're the last people to pay, the last payer. Now, with the $11,000, there's an overpayment of $1,000. So person number 2 being the last person to pay, and they overpaid, that person, only that person, not you who paid earlier, person number 2 is entitled to a refund of $1,000. So that's how that works. So the IRS just doesn't do a great job of controlling this. It's their system. It's arthritic, and the computers aren't programmed to do it. They don't have the process to do it, and the resources. So you can request a refund if you're the last person. You can even request a refund if you're not the last person, but don't count on getting necessarily count. It's the last person who's most likely to get his money. So if the IRS I guess what I'm trying to say is you can't really control who's paying how much and when it's collected, because there's so many different things, moving parts that you don't have any control over, whose bank account's getting levied and who's sending money in, and so if you pay more than the other responsible parties, you can sue them in equity court, but of course this is going to be expensive legally, and it's going to be time consuming, and the outcome of that can be quite uncertain. This concludes part 1 of this video series. Please continue by viewing part 2, and you can find links to all parts of this series at www.taxules.com/tfrp.htm.